Okay, so everybody welcome and thank you all for joining us this morning. A couple things I want to get started. I want to go through before we get started. I'm going to go through some housekeeping items. Everyone's going to be muted because we all have noise behind us that we don't realize is actually happening. So we want to be able to give our speaker the floor today, so I will mute everyone. What I'd like everyone to do is to scroll over your screen and click on the chat icon at the bottom center of your screen. In here, you're going to see a message from me right now. If at any point you have any questions, feel free to add questions through there. We'll go through them at the end. And then if at any point too, you want to send me a private message too, maybe you don't want the question to be posted up there, that's fine as well. You can actually choose that by clicking the drop down of who you'd like to send the message to. So again, thank you all for joining. My name is Brittany Cartwright. I'm with the Palm Beach North Chamber of Commerce, who is hosting this webinar. And we are joined today by Al Townsend of Townsend Financial Life Management. Al is a partner, private wealth and institution asset management. He is a seasoned veteran of the financial services industry with over 43 years of investment and wealth management experience. In addition to having been a top advisor for several of the United States' largest financial firms, he has consulted with hundreds of financial services firms around the world, helping them advance their private wealth businesses. Without further ado, take it away, Al. I'm going to go back. I'm going to remove my video and I'm going to also mute myself, but if at any point, I will unmute myself and let you know if there's any issues we're running into, but feel free to take the floor.
Great, thanks, Brittany. No, I don't think any one of us could have envisioned 3 months ago where we find ourselves today. We're in the middle of a worldwide pandemic and there's a global economic shutdown, which I think has affected pretty much all of us, both emotionally and financially. Now, there's an old saying that life is a journey, not a destination. And for most of us, our first destination is our retirement. And it's always important to recognize that there are going to be accidents and detours along the way. We need to make sure that we have a way to navigate around and not get stuck or lose our way. So whether you are a business owner, self-employed, or an employee, what we will look at today are 8 ways to financially survive and, more importantly, perhaps take advantage of some of the opportunities that exist in the environment today. So over the last 43 years, as Brittany had said, I've seen a number of these traumatic events take place. We saw hyperinflation at the end of the 70s and into the early 80s. We saw the recession that resulted from that. Black Monday in 1987, which up until just last month was the worst decline the market ever seen. And then we had the tech bubble in 2000, for those of you that remember 20 some odd years ago. This was followed up by 2008 and the financial crisis. And all of these had different catalysts that caused the disruption to the markets in our lives. But nonetheless, there was a lot that we could learn, and that we did learn from that. Given the current events and the barrage of bad news and noise, the challenge to make sure, there is a challenge to make sure that it doesn't cause us to make bad decisions or freeze into a state of indecision. So I guess the first piece of advice that I would offer today is don't panic. Any successful journey really requires that we have a good map. And you know, it's one of the reasons why we can pretty much make sure we don't get lost for the most part. It's also why Google Maps became so popular. You could plug in the destination and it would immediately tell you the best route, shortest time, and more importantly, if there was an accident or a detour, it would immediately, give you that pop-up and say, here's a reroute that you should take in order to make sure that you stay on track and you eventually get to your destination. And again, the shortest and safest possible way. Well, your retirement plan and your financial plan, and if you have an estate plan, that's really your Google map today. Not having this kind of map can be very, very stressful. And 2 days ago, I met with a new client. Didn't have a plan and visibly stressed out over everything that had happened and really was floundering around wondering what was going to happen to them and their plans to move forward. We sat down, we worked through it, we created a plan, we worked through all the important scenarios to help him understand how he might be able to get to where he was going, looked at the resources, went through a budget, actually helped him create a budget around how he was spending his money right now. And we developed a plan for him. And I would tell you that probably the most important thing right now for him was having that plan, because you could see the stress just fall right off, because now he felt very comfortable that it wasn't going to completely take him off track, and he had a way to move forward. You know, we've in the last month had all of our meetings with our clients, and it just happened to fall on a quarterly event. But we go through all of our plans with our clients on a regular basis, and you know, this is one of those pop-up moments when it's time to review those plans, where we look through the budget and we reposition assets where appropriate, you know, do rebalancing if it's appropriate as well. And we look for ways to ultimately move this in the direction that they need to, and know exactly where they need to be going in order to get to their retirement. So this is the number one thing on the list that I want to offer up today. And that is that your plan needs to be reviewed so you can identify, you know, alternative routes to get around. And we're definitely in an accident here. And hopefully it'll help reduce some of that anxiety or stress that you may have. And I was speaking to one person as we were getting on the phone here, and we were talking just about that. I don't know about you, but the shelter in place has definitely altered my wife and my spending habits. Now, it's good and bad. The good part is we're spending less, which means that, you know, depending upon how long this goes on, there's obviously more money there to take care of our day-to-day expenses. The bad news is that we don't know how long it's going to last. So during this detour that we've got in our little journey, it's a real good time to check the gas, you know, your gas gauge and your provisions. You know, dusting off that budget right now is a real good way to find places to save, especially because you want to make sure that that money is available for all the important things that you may need to be spending it on, or it'll help give you an idea of where you might be able to make some changes. Because let's face it, we just really don't know how long this is going to last. So this is all a part of the planning process. If you don't have one, this isn't unusual, and we see it quite a bit when we meet with new people. But it is extremely important. You may find an awful lot of value in having someone to consult with, and make sure that it is incorporated into your plan to make sure that you're able to stay on track. Now, one of the other things that you might look to here when you're going through this is maybe it's of value to have an impartial arbitrator and help guide the process, because every now and then, if you have a partner, you all might not agree as to what's the priority and what should be addressed, or i.e. where you need to cut back on your expenses. Now, it's always recommended that you have at least 3 to 6 months of expenses in cash. And it's a real good opportunity or time to really identify where those next sources of cash might be if those reserves, whatever they were, run out. And what I'd like to do right now is I want to share with you the top 4 potential sources, actually the top 5 potential sources that you may want to look at should that need arise and this carries on longer than we want it to. Now, one of the things that did happen was the Coronavirus Aid, Relief, and Economic Securities Act, better known as the CARES Act, it's a whole lot easier to say, did give us some relief. For those of you that qualified, we all know that you got $1,200 as an individual, $2,400 as a couple, $500 for each child. And that may have helped a little bit. But again, let's get rid of some of the stress that you may be having and anxiety, and let's make sure that you're comfortable knowing that regardless of how long it takes, that there are other sources of money. And I'm going to go through these, and if you want to take a few notes, it might make sense. So the first place that you might want to look is taxable brokerage accounts. Why? Because they're extremely liquid. Now, when you look at those, there's probably a priority in which you want to look at how you might want to sell some of those or turn those into cash if you do need it. I'd start with money market accounts. And then the second thing I'd look at is perhaps short-term bond funds or high-quality bond funds if you have those in your portfolio. Why? Because they haven't perhaps gone down. and you won't be subject to losing the potential gains like in equities when they turn around and they go back up. Now, whatever you do when you look inside this brokerage account, there are some things you need to be aware of, and one of them would be capital gains, because you don't want that tax to eat away at some of the money that hopefully you're trying to save and keep in place for not only your current expenses, but also, for your own savings. Try not to sell securities that really would have that potential to grow when this market recovers. Now, another one that's on the list that you want to take a look at are Roth IRAs. Now, if you own one of those, and if you have one, and if you held it for more than 5 years, now this is an individual Roth IRA, you can take out what you have contributed up to this point with no penalties or taxes. And one of the advantages is that money that comes out of a Roth is first in, first out. So you don't have to pay tax on it. And again, if you take anything above that, like anything past what you contributed, that would be the growth in there. And you would be taxed on it. And there would be a penalty on that money of 10% if it happens before 59.5. Now, there are other rules here, and you really want to walk through this with your own personal situation with an advisor or someone that can help give you some of that guidance. All right, number 3 on the list is cash values on life insurance. Now, depending upon whether you have a universal life or whole life policy, you may have built up some of these cash values inside the policy, which you can take out, and it does come out tax-free. But each policy may be a bit different, and you need to be aware of what effect it may have on the policy itself, the death benefits. And one of the things you definitely don't want to have happen at this time is to have that policy lapse if you're not able to make some of the premium payments on it. Now, there are 2 ways that you may be able to tap into your 401k plan. All right, here's one of those areas that you want to be very careful with, because these are your retirement savings. So let's start with loan provisions. Most plans do have these in place, and it in the past has been you can have up to 50% or $50,000, whichever is less. The Act stepped in here to help us a little bit. That said that if you need to take 100,000, you can do that, but it still can't exceed 50% of that balance. So again, it's whichever is less. Now, the goal here would be that if you do have the loan, you do need to have a plan to pay that back over the next 5 years, and you will be paying interest on that money. But here's the good news: you're actually paying it to yourself. Now, unfortunately, that interest is kind of nominal. It's not that great. Now, the other downside to borrowing money against the 401k plan is that that money actually comes out of your investment. So that won't be growing in those whatever investments that you had it in during the time that it's out of the plan. Also remember this, that if you do not pay that back over that 5-year period of time, you're going to pay taxes on that money at your current income level, or income tax level, and you will have to pay that penalty of 10% if you're under the age of 59.5. All right, if you're a qualified individual, the CARES Act has stepped in again. Now, what does qualified mean? Qualified means either you have the coronavirus or have had the coronavirus, or someone that you're caring for has it, or you have been financially adversely affected by the coronavirus, like hours being cut back, or perhaps you lost a job. And what this does, it allows you to actually tap into your 401k. This would mean taking a withdrawal from that. Now that means you're actually taking it out of your 401k. And it's allowing you to take that $100,000. Actually, you can take pretty much whatever you want out of it. But here's the benefit. You don't have a 10% penalty. They waived that. They've also waived the 20% withholding for taxes. Now, the other good news is that you do have to pay tax since you did withdraw from it, because in a 401k and an IRA, that money's gone in pre-tax. So anything you pull out will be taxed. But the Act, again, gave us the opportunity to spread that tax liability over the next 3 years. If you put the money back, and it's strongly recommended that you have a plan to be able to do that, those taxes, if they're paid, in other words, if you don't put it back in until 2 years from now or before the 3-year time limit is up, you can get a refund on all the taxes that you paid on it. Now, again, anytime you tap a 401k account, bear in mind that there's something important here. That was for your retirement. And there can be a cost, a significant cost down the road. Let me give you an example. If you were to take $5,000 out today and you weren't able to put that back into the plan, or you did not put it back into your retirement plan, in 20 years, that could have actually accounted for about $16,000 of additional money that you would have had when you retired. Okay, the last one on our list here is home loans. That is another one, and I've kind of ordered these in priority order. I mean, there's HELOCs that are available, lines of credit. You might even look at a reverse mortgage. But I would suggest to you that there's been a lot of news lately about a lot of the institutions that lend money on this are starting to pull back, or they're raising the requirements to actually make those loans. Now, what I've offered you are 5. We actually have a list of 10. There are 5 other sources. And what we've done is these are broken down in priority. So if you were to look at what you would want to go at first, second, third, fourth, all the way through 10, we do have that list, and be happy to send it to you if you ask us for it. Again, having a well thought out plan, for this eventuality can really help relieve stress and anxiety. And you're pretty much removing one of the unknowns that exists out there. All right, if you are a business owner, and remember what this is intended for is different areas. So if you own your own business out there and you offer a workplace retirement plan, first of all, this is a very, very valuable benefit that allows your employees to save for their retirement. And it's important to provide resources for those employees today to be able to make good decisions around how they are using that retirement plan, either continuing to make contributions or if they have to take a loan or withdrawal from it. This afternoon, we have 2 webinars for the employees of 2 companies that we are the plan advisors to do exactly that, to provide them some insights as to how best to manage some of the challenges that they're facing during this crisis. All right. Businesses are looking at ways to keep their company going, to continue to be viable. But at the same time, retain and keep those key employees in place. Now, I'm a business owner, and I know how tough a balancing act this can actually be. Right? If you have a safe harbor plan and you're providing matching contributions, better known as non-elective contributions, to your employees for their contributions, and if by doing so, it will put your company at risk, you can look at reducing or pausing those non-elective contributions. Now, I'm going to tell you, this isn't normally allowed. But if you look into the language in your plan, somewhere deeply embedded in all those pages that you signed off on as the sponsor of the plan, you may find out that it is allowed under certain circumstances. If it's not there, be aware that there are some IRC guidelines that if a company is under extreme economic stress, that may give you some leeway in being able to pause or reduce those contributions. Again, this is one of those things that have to be done very carefully and balanced against, the ability for the company to continue to provide that benefit but stay viable. Now, be aware there's a couple of things here. First of all, if that's a direction you do decide that you want to take, it's not something that you can pull the trigger on right away. There's a 30-day notice that has to be provided to the employees. Another consideration is that if you do that, you will no longer be a safe harbor plan. And many of you have that in place because you want to avoid ADP and ACP testing to see if you're top heavy in that plan. Okay, one last area. If you deem it necessary, and if you offer a simple IRA in place of a safe harbor 401k plan, that probably has a 3% mandatory matching. Now, this is one area where you can't change it mid-year, but at the end of the year, if you see the need for your company to cut back on that expense to make sure the company is running and it's there and you're able to keep your employees in place, you can make a change at the end of the year for 2021. This is one of those places where you definitely need to get advice and talk to your plan advisor. And you need to talk to them about two things. First of all, how to make sure that your employees are getting the right kind of advice right now in this environment, and also to help you make sure that you communicate these changes so that your employees don't see this as being detrimental to them, and that the benefit, still potentially will be there for them in the future if you have to make that change. All right, I'm going to shift gears a little bit for you here. And the way that I want to shift gears, and I want to talk about the way that we might be able to take care of some opportunities in this environment. Now, Roth IRAs have become very popular, and become popular for very good reason, because when you put that money in, and you put the money in after tax, that money grows inside there tax-free. And that allows that money to compound, and you're not paying taxes on it. But the other benefit of that Roth IRA is the fact that when you pull the money out, it comes out tax-free as well, which can be very beneficial in retirement, because you're not having that money taken away that you would have otherwise used for whatever it is you want to do when you're in retirement. So the challenge in the past for being able to do a Roth conversion out of an IRA, and that's specifically what I'm talking about here, was moving, because the value of the securities had appreciated so much in the past, and it would have created a huge tax liability. Because remember, when you make the conversion, any money you pull out of that IRA will be taxable that year. Well, market dips can present some really good opportunities, and that's to reduce this tax liability, because you can actually take those shares if they're depressed and they've gone down, and many of them have, and you can actually do what's called a transfer in kind to a Roth. So what would have been a higher tax liability in the past would be reduced, and you'll be able to actually move those securities into a Roth, and it'll afford you a much lower tax bill in the year that you do that. So it may be a way to take advantage of this. Now, this is primarily a tax consideration, and it's an individual decision that you would have to make. And one, again, put it into context with your plan, and it might be a good one to get a little advice around. All right, I'm going to throw a little alphabet soup at you right now, because there is potentially an opportunity to use a QHFD to fund an HSA. Okay, let's break this down. An HSA is a health savings account. And again, these were put in place a number of years ago as a way to help people pay for unplanned medical expenses before they're in retirement, as well as when they're in retirement. And they have a lot of the same benefits as a Roth. The money goes in, and when it goes in, it grows tax-free. But more importantly, when you pull that money out for a qualified expense, it's also tax-free. So it's a way for you to make sure that you have a separate savings account that will allow you to pay for medical expenses, these unplanned medical expenses that we all have or will likely have in the future, without it taking a big tax bite out of your savings that you hopefully are putting away for all the other things you want to do in life, and as well as in retirement. Okay, well, the timing may be right, for the same reasons as we were talking about making the conversion in the Roth, to do a once in a lifetime, and here you go, qualified HSA funding distribution. That's what QHFD stands for. But bear in mind, this is a once in a lifetime. And it allows you to move that money to that HSA without any tax liability or a 10% penalty for moving the money out of that IRA. Now, again, remember, the securities in the IRA may have gone down in value. So again, you've got the opportunity, because in any given year, and this year in particular, you can contribute up to $3,500 as an individual or $7,100 as a family to an HSA account. If you're 55, you have the benefit of perhaps doing an additional $1,000 as well. This is one of those things where you absolutely should, take a good hard look at your plan and consult your advisor to make sure that this is consistent with what you would like to do and how you want to allocate your savings. All right, here are 3 other potential opportunities. And it has to do with your investment portfolio. Number 1, this is an absolutely great time to be rebalancing your investment portfolio. Why? Well, because it's probably out of balance. Bonds have probably done very well in your portfolio or much better than securities, and securities obviously have sold off significantly. And as a result of rebalancing, it puts it back consistent with your objectives and what that portfolio is supposed to provide for you, and also maintain the same risk profile for you in order to achieve your goals. Now, there's another good benefit to doing this, and there's a fair bit of research out there that says that if you rebalance on a fairly regular basis and take advantage of situations like this, it actually has the ability to enhance the overall performance of that portfolio over time. And there's studies out there, and we can share those with you if you'd like. All right, the next two ideas, potential opportunities that you may want to look at, build off of the premise that after-tax returns are extremely important, because the more you can do and avoid in terms of paying taxes, the more there is for you to spend or to save. All right, and the goal here on these is to improve tax efficiency and improve long-term returns. First one of these two that I want to share with you is called tax loss harvesting. Now, what is that? In essence, that's selling a security today to realize a tax loss that you can use to offset any capital gains that you might have this year or in future years, because it can be carried forward, and to be able to use some of that to offset any earned income that you have. And for an individual, you can offset about $1,500 of income or $3,000 if you're filing jointly. Again, the goal here is to make sure that there's more money left for you. Now, the tax loss harvesting strategy basically says you want to sell the security, but you don't want to lose the opportunity to continue to participate in growth when that security goes back up in value. Well, you can't turn around and buy that same stock the same day or the next day. That would be in violation of what's called the wash rule. And the wash rule says that you can buy that stock back, but you have to wait 30 days. Okay. One of the things that you may not want to do is stay out of that market for 30 days. And the other strategy is to find another stock that is very similar, has the same characteristics, and perhaps has the same ability to perform in the future. And when you sell the one stock, is just to simply simultaneously buy that other stock. Again, another one of the strategies, and you have to look inside your portfolio and see if that's available to you. Next one is called improving tax alpha. And you do this by reallocating assets into the most tax-advantaged accounts. Now, we already talked about some of these, and one of them is like an IRA. That's what's called a tax-deferred account. If you don't have a separate IRA, and if you qualify to be able to do that outside of any other retirement plan you're in, it makes sense because, again, that money goes in pre-tax so that you eliminate paying taxes today. It comes off your portable income this year, grows tax-free, so you've got that compounding effect. Another vehicle that allows you to do that is annuities. Annuities, when you put the money in there, it grows tax deferred. So that money compounds. That money that otherwise would have been paid for taxes is actually out there working for you. Now, the next one is the non-taxable. We already talked about those, and those are Roth accounts, because we know that that money goes in after tax. But again, two benefits. It grows tax-free, getting that compounding effect on those tax dollars you would have paid, but more importantly, it comes out tax-free. Now, here is one thing for consideration. And there's a rule of thumb out there, and when you're discussing this and when you're looking at how to take advantage of it, is that your highest long-term expected return assets, those are the ones that you think have the greatest level of appreciation, really would be better allocated to a Roth account. Why? Because all that appreciation comes out tax-free at the end. All right, maybe a very good time for you to look at moving this money around, doing a little bit of this relocation, tax alpha, maybe a little tax loss harvesting. But bear in mind also that it's something that you may not want to wait too long on, because, again, who knows what's going to happen. The market's been incredibly volatile, and we would tell you that you can't really time the ability for when that's going to turn around and go back up. All right, the last thing on our list, and this is not a subject that people like to really talk about because it has to deals with end-of-life care. And this is where and this is, by the way, something that should be done on a very regular basis, and that's review proxies and your wills and your advance directives. And now is a real good time to be doing that, because what we have found is some scenarios that perhaps we hadn't thought about when we put these together or when these documents were put in place. Like, for instance, the terminology that exists inside these policies. I mean, some of you may be very specific about the fact that you don't want any means of artificial life support being provided or should be used with you when you get into a situation where there's the likelihood of not making it. Well, think about this. With what's happened with the COVID-19 virus, we know that there has been great success in the use of ventilators. And there may be a need here to have that changed. This is something that you need to sit down with and talk to an attorney about. But it may read something more like no means of artificial life support should be used once doctors have determined that there's a good probability of return to normal life. Now, look, I'm not an attorney, as I mentioned, but it is something that you should review and get some advice on. Now, there is one other thing that's important here, and that is your surrogates, your personal representatives, and perhaps the person that has the power of attorney. You got to think about where you keep your documents right now, and do they have access to it? Because in this environment that we're in, and this is something new, we are locked down, or travel is perhaps dangerous and might be harmful to those people that you've given that responsibility to. So one of the other things you might want to look at is looking at what's called an e-vault. And companies like myself and many of the other companies out there have this service that is available to you, and it allows you and only those other people that you designate to actually have access to those documents should it be important. So now really is a tough time, and this storm will eventually pass. And I want to put it out there that for all of you that have suffered and those that have lost family members or friends, we offer our deepest condolences, and our thoughts are with you. This crisis is eventually going to come to an end, either through its normal cycle or the combination of social distancing and science. But I want to make sure that if there's one thing that I leave you with, it's this, is that this is the time to be having these conversations with your professional to make sure that you are making good decisions that are right for you. And be very, very careful about letting your emotions get caught up in this. One of the things that sometimes I think is important is turn off the news. Don't look at it, because it can drive you into a frenzy sometimes. Also, remember that your plan is your Google Map, and right now there should be a pop-up saying rerouting to help you stay on track, or at least not get too far off course here with what's going on. Again, this is just part of the journey that we're on, and we're all going to get through it, and we want to make sure that we get through it in the best possible way. And that's my objective here. And if you don't have an advisor, or if you're really looking for a second opinion, to see if there are things that you can be doing, please contact us. We would be very happy to have that conversation. And by the way, if it's something that you want to do, I think Brittany's going to give you an access to it. And I've also put it on the screen here in terms of an online to be able to put some time on our calendar, and we'd be happy to do that. Brittany, I'm going to turn it back to you if there are any questions.
Okay, wonderful. So if anyone has any questions, they can feel free to put them in the chat box right now. You can either send them to me privately or just post for everyone to see. A couple of questions. Let's see. How do you determine which accounts to use to improve tax efficiency?
Yeah, and that's an individual, it depends on each individual's scenario. What it really comes down to is that there's a hierarchy that is developed around different account preferences and how they're used in your overall investments. The idea being that you want, as I mentioned earlier, those things that have that greatest growth potential, you usually want to put those into things like a Roth account, or at the very least in something that can provide deferral of the taxes so that you can allow for that compounding. But again, the goal here is to take a look at what the plan is and what your situation might be, perhaps at the time of retirement, or as you would have a need to draw down those resources. Remember, there are things like health savings accounts that if you're in a high deductible plan, and if you qualify based if you're on a plan with your employer. These are places where you might want to start putting monies away, again, because these are tax preferred or tax preferenced areas to do it in.
What would be your best advice for someone who is single, doesn't have any really family? What if they had to get cash now and they had, let's say, everything set up, money market accounts, Roth accounts, your best advice on which money account to touch right now in this crisis?
So it's a very personal question, and it has a lot to do with what's in those accounts, how they're positioned. Ideally, what you want to do is you want to tap into those that are very liquid and that won't significantly impact your those savings ability to grow over time for whatever your goals might be. And we all have both short-term and long-term goals. So you would want to analyze that, and it would be a bit around the pecking order or that priority order that I mentioned to you. So you'd look at, taxable accounts first. Then you'd want to look at perhaps your retirement accounts. Then you'd have to decide whether it's better to do a loan or whether it's better to do a withdrawal under this scenario. Again, there has to be a plan in place whenever this is done in order to make sure that you have the ability to get back on track in a reasonable period of time. And by the way, I'd be more than happy to send you that list because it's a pretty good way of describing how it might be. And of course, we're always available to answer that question for you individually.
Okay, wonderful. And then what are the risks against borrowing on someone's 401k?
The biggest risk of borrowing on a 401k, and they're really two. The first big risk is that if you don't pay it back, you're going to get hit with a tax and a penalty if you're under the age of 59 and a half. Okay, that's one of the biggest risks. So there really should be a plan to pay it back. The second risk is when you pull money out of that 401k, whatever you had that invested in is no longer going to work for you. It's actually removed from those assets and those assets. So let me give you an example. If you had 4 different mutual funds that you had your 401k invested in, what it would do if you took a loan, what they would do, unless you otherwise indicate with them, they would take 25% of whatever that loan is, and they would take that out of each one of those 4 mutual funds. So again, you've lost the ability for that money to grow inside that savings vehicle. Now, you are getting some interest because basically you're paying yourself that interest, but it's not very high right now. That's usually somewhere around a LIBOR rate plus 1%, and that's extremely low.
Okay, wonderful. And then you had mentioned at one point the companies that do contribute to their employees' 401k plans. Do you suggest that every company do that? I know they could be personalized for each company, but do you generally suggest that most companies should at least put it on pause for a month or so?
Okay, I absolutely do not recommend that every company do that. That is one of those benefits that there are 2 very good reasons to keep that in place if at all possible. First of all, it's important to the employees. It's critical to the employees to have that vehicle, and if you're supporting them in that, to be able to make sure that they're saving as aggressively as they can for their retirement. And the second one is that when you take that benefit away, it may cause some concerns for your key employees. And bear in mind that a lot of companies don't want the testing that would follow up if they come out of that, because anytime they do that, they fall out of the ability to call themselves a safe harbor. It is absolutely one of those things, and every company should have a qualified plan advisor that is a fiduciary that is experienced that can dig into that and help them come up with the best way to do that. And if they do have to pull that money out, or they do need to have a pause or reduce those contributions, they're the one that can help, guide in that process the most effective way to do that and to communicate that with the employees.
Okay. All right, well, I think that concludes all the questions that I've received. So Al, I want to thank you so much for your time today. I know the bits of information that you shared were very helpful for a lot of the individuals on this call. So thank you so much.
Thank you, Brittany, and thank everybody for participating today.
Yes, and everyone stay tuned. We have more virtual events coming up. Check out our website, pbnchamber.com, or our Facebook page, and feel free to join us. We'd love you for you to join us. We have a Tech Toast event this evening. Starts at 4 o'clock. Sign up online. It'll just be kind of a more relaxed, get to know everyone in this virtual setting that we have now. So thanks again, everyone. Have a great day.